All right, hello everyone, and welcome to this live panel discussion. Sorry, I shouldn't say that. Hello everyone, I'm Jan Mutat, Chief Market Analyst for TIOmarkets, and it's my pleasure to have you in this panel discussion. We have Yohai Ilam, we have John Noble, and we have Gonzalo Moreira. And briefly, I'm going to introduce the gentlemen, telling you what they've done before, and then they can introduce themselves. So first of all, Yohai, you have been a senior financial analyst with FX Street, focusing on technical analysis. Beforehand, you have founded Forex Crunch and traded Forex as a retail trader. John is a professional investor and owner of J Noble Investor Services Limited, which is a European regulated investment advisory firm specializing in alternative investment strategies. And Gonzalo has worked for FX Street for the past 12 years, where he helped the company to create tools and services for traders. His experience is in automation and discretionary methodologies. So basically, this is the intro. Thank you guys. Yohai, tell me a little bit of yourself. How did you get interested in the markets, and what's your approach to markets?
Well, I always loved moving numbers from being a small child and patterns like many other traders, and actually had a career as a computer programmer, but a friend of mine got me hooked onto Forex trading, grabbed me into a course, and then I moved on to creating my own website, writing about markets, began trading, and so I'm interested in macroeconomics, the big things that move markets, and also these price patterns and indicators that we're going to talk about later on.
That sounds good. You mentioned you've been a programmer before. Did you ever feel that you could actually do something that I know Gonzalo has done, something related to automated trading instead of discretionary trading?
Well, I never dipped my toes into that. I separated back then my work as a programmer and my passion for markets, and passion can be an issue because you get I got too emotional when I had money at stake and had my nose glued to the screen rather than having a computer program doing the work for me. And I think it's a lesson that I've learned and many new traders should be aware of.
Sure. Then John, tell me a little bit of yourself. How did you first got interested in the markets? What sparked your interest?
You mean getting good at the market, or initially getting in the market? Because there's a difference. Well, I mean, it started, I guess, about 21 years ago when I was a financial advisor at Morgan Stanley, dealing with retail clients, and specializing in stocks and equity-related derivatives. And it's great to be a young stockbroker because you get to learn with other people's money. You're not at the level where you're trading on your own, but you're watching the market, and you're advising people that probably at that point in time, maybe they even know a bit more than you, but you got a brand behind you, and you just passed your Series 7, and you're young and full of energy, so you start bringing in your business, and then you learn by doing. So that's what initially brought me into the business, and then moving on in my career, I went from advisory roles to a head of brokerage roles to a head of asset management, a head of investment research, and then proprietary trading. So it was basically just, it wasn't one single event, but it's been an ongoing learning experience even to this day. So to sum it up, my best experience has been when I zeroed out a fund I was managing. That was I would say that was my best that was the best lesson, but worst experience. Let's put it that way.
We can go back into that at some stage. We briefly touched upon this earlier, and I would like to hear more about this. We might have questions here. Others might have questions on this too. But if we think about the early beginning, you could have actually, working as a financial advisor, you could have sort of chosen investing instead of trading. What attracted you at the end of the day into trading the markets instead of just investing in the markets?
Fear.
Can you explain a bit?
Fear. The fear of losing money, the fear of having drawdowns, the lack of control, by just putting money behind investments and then hoping that they would go up. So that, I mean, as you develop as a trader and you become more technical and you get these experience, you're able to understand things that are like momentum, when you know that there is a time when you're going to enter the market and you're going to let the market do the heavy lifting. You're going to let the market do the work for you. So what we're training for every day is to identify these trends as a momentum trader, and my mission is to identify trends at their inception and then to carry and trade with those trends as they develop. So it sounds like, yeah, okay, that's easy, let's do it, but it's not. I mean, there's a whole lot that goes along. I'm sure the other guys can agree with me on that.
Sure, we do. You have an indicator in mind, because the idea in this panel discussion is to look at the indicators that are most valuable to us. So if there was a desert island situation, you would be trading under the palms on the sandy beach using your laptop on a desert island. Hopefully there was a good internet connection. But what would be the indicator that you would take with you?
In who's this question addressed to?
This would be to you, yes.
Oh, I keep it simple. I don't like to invent things. I'm a big fan of Martin Pring, so I use his no sure thing, which is it's a 10 period SMA. That's a simple moving average, and I use 2 rate of changes. I use a 4 and a 13, and I get confirmations on my trades when all 3 of those indicators are confirming one another.
Okay, let's look at the indicator or the set of indicators a little bit later in more detail. But I forgot to ask you, Juhai, what's your favorite indicator?
Yeah, so I keep it even more simple. I look at the price. If price of foreign exchange currency pair hit a double top or double bottom, that's for me a meaningful line. And I think what many traders are looking for, if it reaches that top and makes a big move higher, that's a good breakout. And if it fails there, and we can expect mean reversion, and unfortunately unfortunately for those looking for the big dramas, many good trades are done with just mean reversion, just a rejection and this range trading, which can be oftentimes frustrating. But and these lines that are attacked more than once, these are usually the lines I'm looking for as
okay, so you basically want
price levels.
So if I understand you correctly, you want to see several touches on a support or resistance level before you are going to trade against it.
Yeah.
Let's go to, and again we come back to this idea because there's a lot to talk about, price action analysis, support and resistances, and price being the leading indicator. But first, Gonzalo, how did you get interested in the markets? You mentioned about Forex risks yesterday. What's your approach? I'm sorry. First of all, what was the thing that attracted you into trading instead of investing, and what's your approach?
Yeah, initially I was trading back when the euro was implemented in an import-export company, and I was waiting for a pay on a product we sold, and I had this nominal amount that I was expecting in euro because that was my my currency, and I was then paid in dollar, and there was already a devaluation, 10% or so. So I got involved in with currency risk. I was already familiar with exchange rates because I was born in Portugal. We migrated to Germany, so we changed to German marks, and then my father was living in Spain, Spanish peseta. So I was already from my childhood living with these different currencies, but the risk in the currency risk was something that was at that time new to me. So it's like exploring how I could get those 10% back that I lost somehow. And that's when I got involved with Forex, started learning, and later on I went through the Market Technician Association, got the CMT grade, and met a lot of people along the way, and diversified also my career partly into automation. I'm very in favor of simplicity, like John and Yohai said, but requirements at work not always allow you to keep things simple through the years. But so I worked with complex strategies as well. But if I would bring that simplicity rule into complex trading strategies, I would say that even if you think of an indicator, let's say I can talk then what my preference is, but I would say if you develop a trading methodology, do not start with a tool, start with a concept. Start observing the market, a market of your choice, and then keep it simple in terms of observation. Say, what do my eye recognizes on the market? It can be something simple like, most of the days the market goes through yesterday's high or low. Yeah, an observation like that, and then you start measuring how many times it does, and how far the market goes, and what are the conditions when that happens. So you start with the concept, and then you go on to the tools and say, well, perhaps I need to measure momentum, or I need to measure volatility, and then you grab the tools. And it's important that you know the nature of each indicator, when it was created, and its formula, so that you know what tool to grab to translate price action into a different series that will tell you something. So if you start with indicator from scratch, and let's see what an ACD gives out signals, it's a recipe for losing money, because the indicator is done for producing signals. But what kind of signals do you want? There are many nuances in each indicator.
And at this stage...
Well said.
That is so true.
Thank you.
That is so true. Do you guys want to comment more? Yohai?
I'd like to listen to him a little bit more.
Yeah. So basically what you're saying, Gon, is that it's not only the indicator and signal, it's also the interpretation and what you take out of it, right?
Excellent. Yeah, because a single indicator has so many nuances. Because in fact, most indicators are just translating the price action. My preference is the RSI, but I could just take the RSI off the chart, and I would see the RSI already just by looking.
Exactly. Yes. I think if Jan, if you'd let me on this, I think because probably most of you in the audience, may be new to trading. You have some experiences, and us old timers over here who've been in the battles and still in the trenches, we could look at a chart and then, without having indicators on it, and then we could know what those signals would look like, by putting it on. So yeah, and that's price action. I mean, and you can see that. So I totally agree with Gonzalo's approach to looking at a theme or a concept, and then working from there. So you find a trade, you find an instrument that makes sense to you, that you're comfortable with, and then you smooth it out. You're going to identify it. It's going to be rough, and then you smooth it out with the tools you have in your basket. Yeah,
exactly.
So, well said.
That is so true. I think most of the new traders they make the same mistake. They start looking at the packages, the software packages and trading platforms, they are often advertised with how many indicators you can have there. So they intuitively start thinking that it's the indicators that are the thing. But indicators only take in price action and feed out plotted lines. So I think we all agree here that it's the price action that really counts, but indicators can be useful as a highlighting tool. Okay, now the market is doing something, because I'm browsing often through like I think hundreds of charts per day, and often I'm looking at just glancing the charts, wanting to see where the moving averages are pointing to, where the oscillators are, and then also look at what's happening in the price action. But the actual price action at the end of the day is the factor that will trigger me to take a trade.
Yeah, and it's also, pardon for interrupting. It's worth putting it simple, the analysis part, because if you trade the markets, then there is the execution part and the risk management part, which can be also more or less complex, but it's also a part. As retail traders, we usually do all things. We analyze, we execute, we control risk. Usually, those roles are many times in capital management firms are done by different people. Here at home, a retail trader at home has to think of these different blocks in doing them together. So if you can keep the analysis simple, it helps them to concentrate on the other parts, because in execution you can have many times we talk about the signal and the entry, but you don't have as many choices entering the market as you have exiting the market. You can exit at profit, at loss, at break even. And then you can add to the trade. There is a position size calculation and so on. So you have more options. In fact, we have one strategy running at our service in FX3 that enters the market randomly. It chooses the direction randomly and the time of the day randomly. Just focuses on the time window where there is more volatility, so that the trade is you get a little bit of momentum, so you have the chance to liquidate that trade a little bit faster, be it in loss or in a profit. But it's triggered randomly, and then the rest is done by money management, so risk management, position sizing, and so on. And so you could also try to just do the exercise, go back in time and just enter trades randomly and try to exit them. It's a very interesting approach, and I knew people along my career that worked this way. They took as signals, they took things that were even not on the charts, were at home or in the garden, something very bizarre, just to have
a cat jumping over the fence.
Yeah. There was a guy in New York that he traded this way, and then he managed the trade.
Yeah,
and
this is a great example of what we should focus on in trading. We so often are focusing on entries. Most traders are interested in entry techniques. So if you write a blog post on risk management, you get few clicks. But if you write a blog post on trade entry systems or indicators or just strategies for trade entry, people are interested, and that's interesting. Basically, what you are saying, it's the risk management that counts, because if you are entering
100%.
If you are entering the market with random signals, then the only thing that counts is your risk management, right? But let's get back to this.
How you exit,
Exactly. So let's get into this in your turn a little bit deeper. But let me start with your high. You said that you have this idea that you trade against levels. I did ask you to look at a couple of markets that are interesting at the moment, where your main indicator, i.e. the price action, could be helpful at the moment. Can you share those markets? And I'm going to share my screen here and basically show the audience what we are talking about.
Yeah, I was looking this morning at the pound dollar, which is always more fun than euro dollar, a bit more volatility over there, a bit more excitement. And you can see that there's a line there, 138.95, just around 139, which has been very stubborn or so. And yesterday,
just a moment. Let me go there. So it was. Did you say pound USD?
Yeah.
Let's see what we have here. There we go. I'm going to open a new chart. And these are my favorite indicators. I'm going to take them off now just to make this clearer. Okay. So you mentioned a support, did you? What level was it that you're referring to?
Just around 139.
139. There it is.
Support.
This is a resistance, isn't it?
Yeah, resistance. Yeah.
Because the price is below it.
Yes.
Yeah, and chart I have here, FX3 chart. You see it tackling this line, the beginning of August, then a little bit later that month, last month, then at the beginning of this month, and last week.
Okay, so you're referring to...
So it's more or less four attacks on this line that were ejected, and only yesterday, September 14th, we had a move that went temporarily above that line, but again we fell back down. So
you're talking about this move here, right?
Yeah, that was yesterday. Yeah.
Oh, you talking about yesterday's move?
Yeah, yesterday's move was the only.
I think if we put up a daily chart, is that daily?
That is.
I'm looking at a 4-hour chart over here. So.
All right. So yes, this is where the market tested the level yesterday, but couldn't move above it. I'm basically highlighting these couple of spots here because this level has been interesting in the past. The market has hit the level, then fluctuated around it, and it seems to be a relevant level again, just like you said.
Yeah. So basically, for me, price action shows that this level is important if it's tackled over and over again. Also, when there's a big breakout, let's say in this case it would be to the upside, price holds to the upside and then slips back down, but the previous level becomes support. I mean, this kind of separator of ranges is also,
so
I think,
just to highlight this for the audience, you are thinking something like this: the price goes up and then retraces back to the same level.
Yeah. So at some point, yeah, that would, I mean, this level that has been tackled so many times in past 6 weeks or so, I think that once we do get a meaningful breakout, it'll turn into a significant support line. I mean, for me, the principle here is repetition. Is if the same line works over and over again, it's more meaningful than something that isn't tackled that many times.
Okay.
May I
Sure.
To what Yohai said, when I look at a chart that is almost blank like this, yeah, I immediately see the lines that are more prevalent. When I use horizontal and dynamics for resistance lines, I like to find out for each market what is the angle of ascent and descent that prevails throughout the time in that market. Yeah, we can go to markets that are very new, like Bitcoin, for example, where it started when it started trading and it was below $10. We got a high in November 2011, and then we got a breakout in July 12. The descending line that was produced by these points on the chart, and that angle with Bitcoin below $10 is the same angle that we can find throughout history and until today in the chart of Bitcoin, repeating and repeating. So every market, and when you look at this chart that we have in front, and you start looking at those spike highs there and lows, you start seeing an inclination, an angle of inclination that will repeat. Yeah, and if you construct a chart using a grid of lines, of descending and ascending support lines in combination with horizontal price levels, you get a very interesting grid. You get a landscape for that market, and you know where the market is to encounter some kind of obstacle or hurdle, and where it is blank space and the market can accelerate from one level to the other. I like to stalk markets like you would be a photographer or a hunter stalking an animal, and you know where the animal sleeps, where it drinks, where it eats, where, you know, and the animal usually does this circuit several times, and you know at some point you will wake up and go to drink water. Yeah, you know where it sleeps.
So basically, you're saying that a pattern develops. Like here, we have this pattern of market hitting this level.
The market tends to accelerate when there is no support resistance on its way, and usually it follows a grid that is familiar, an angle of ascent and descent that is familiar to from the origin of that market.
Yeah,
so you can work always with the same angle.
Sorry to interrupt you, but just to go back to what Johan was saying, I'm trying to find something that you, in your approach and your highs approach, something that is kind of similar. So you are saying that there are patterns, the market tends to do the same things again and again, and then the sort of where this has an overlap with your highs approach is that we have these areas where the market finds resistance, and those areas again and again are important. So that's an interesting approach. We are a little bit constrained with the time, so I want to move forward soon. But Johan, do you want to add something here first?
No, just to maybe say what you've said in maybe different words, but and what Gonzalo said, it's about patience and observation. And if you stock the animal or the price action, or have enough patience to watch price action, eventually you will get these patterns, and there is no very easy shortcut to grab these to have these kind of observations, and patience is needed. Yeah.
Sure.
I would just like to, Jan, if you don't mind me getting in here. I mean, we shouldn't discount the importance of the foundation of market timing or technical analysis, and that's Dow theory. And so, I mean, the first thing you do is you pull up a chart in the time frame that you're comfortable trading in, and for me, it's a daily chart. And I'll take my observations, let's say if I have a short-term view, maybe going back 6 weeks, and then I will isolate, the price action on that time period going back 6 weeks, and then I'll just ask myself just a couple of questions. I'll say, do I have consecutive rising bottoms on prices? Do I have consecutive rising tops on prices? And within 15 seconds, you could answer those questions. And if you answer no to either one of them, then you have a trading range. And so what does that say about the psychology of the market? It means that the market is undecisive, that there's a lot of indecision in the market. So as a momentum trader, and many of our listeners, our viewers who are out there, that they what I will share with them is that the most dangerous place to be in the market is when the market is undecisive, is when there is no clear direction in the market. That's where you're going to get hurt. And 70% of the time, I don't know if that's an actual number, but let's say a higher amount of time, the market is going to be trading in some sort of a consolidation or some sort of a range. Exactly. So it's the first thing to do is my tool is Dow. I mean, Dow theory. I mean, I do input a lot of fundamentals into my trading as well. I mean, I'm watching the theme right now is inflation. I mean, if you're looking at the pound dollar, you got inflation numbers that came out. CPI came out earlier today that was well above expectations. So is the Bank of England going to make a move? Is there going to be an increased demand for pounds versus the dollar? So if so you see that. You see this range, you see the indecisiveness, and then some sort of an event could be that catalyst or that trigger that then breaks it off into that new that new trend.
Okay.
Totally agree with what John says, that most of the time the market just corrects. It's in Elliott parlance, it's in corrective mode, and corrective patterns are much more complex than impulsive trending ones. It's a little bit like when you have a date and you arrive too early at the place. What do? You stay there for 20 minutes? No, perhaps you say, well, I have 20 minutes, I'm early.
Find another date.
or I just go around a little bit, and sometimes you come even later. But markets do that when they have a target in terms of price and time, and they go too fast. Sometimes they say, well, we are too fast getting there. Just let's meander a little bit, and that's when things got complex, and we get trapped because the target is so clear in terms of price. But the timing, it's very difficult to get, because most of technical indicators are not done to time the market. They're just based on price, so they measure price, not time. So that's why cycles become important here. But the market behaves very much this way, or it passes a crucial time price intersection, has to wait for the next date. So it starts meandering again, and that's when we are kicked off out of the market.
Let's get back into
this
cycles.
Meandering is indecisiveness and when things become a bit more dangerous.
Yeah, true. Let's get back into cycles soon, because obviously we can see cycles everywhere in the market. We can look at those levels, but we can also look at how the market moves up and down. All these are cycles. So it's an interesting topic. But let's go to John now. You had momentum indicators in your charts, so perhaps we can go and use. Did you have a market in your mind that you could
nat gas?
Let me see if I can.
Burning hot now. Yeah.
NYMEX. Yeah. Okay, so here what we're looking at is this is nat gas on a weekly chart, and we're going to take our observations going back 12 weeks. So each one of these candles is going to represent 1 week of price action. So let's take it from the previous week and go back 12. 1, 2, 3, 4. So we're somewhere around here where you can see we've got this break that had taken place. So what we want to do is we want to just basically, we don't care about any price action that happened after that, before that period. So we only care about where we're at now. And so if with hindsight, if we were putting up a 10 period simple moving average, which is this purple line here, so that's a 10-week moving average, and we've got two rate of changes that are here, and then we're going to also add a let's put our signal lines, and we'll put them at 0. So here's a 0 line. Just bear with me a second while we load that up. So you can see, and we'll put another 0 line here. And there we go. So I mean, for my approach, or one of the approaches I have, which incorporates a lot of different factors, is when studying price action. If I want to see that an asset is trending, I would look at this and say, okay, and let's say if we were on back in June, I would ask 3 questions. I would say, is current price trading above or below my 10-week moving average? Well, it's above. So okay, so there's a check next to that, and I'll call that bullish. And then I'll say, is my rate of change, is my faster a rate of change above or below its signal line, which is 0. Well, it's above. Okay, well, that's also bullish. So let's put a check next to that. Now let's look at the slower rate of change.
Sorry, just a question here.
Yes.
John, how do you define it's bullish, just for new traders? Specifically, what in the indicators that you see here makes you think these are bullish indications?
Well, what we're looking here is we're looking for some kind of a confirmation, or you're looking to use a series of indicators that make you comfortable, and you're going to make your decisions based on, and you're going to make trades where you feel most comfortable. And so nobody wants to do, I mean, if you're in a position, if you're in a trade where you're uncomfortable, get out of that position. And so using indicators and doing analysis and all of this, it's not for other people. It's for you. And the reason why we use indicators is to make ourselves comfortable in our trades. So my approach is all about comfortable. I've learned through experience to only make moves when I am comfortable. When I'm feeling uncomfortable, I'm second guessing myself. And if I'm second guessing myself, then I'm losing that confidence, which is vital to trading, and then I'm going to be exiting my trades. As long as my toolbox is I trust my tools and I trust the experience, and I'm comfortable in a trade, then that's going to allow me to hold and stick to a position in open trades. And just for, I mean, there's a lot of different things that I'm looking at, but just for this a panel discussion and for a lot of new traders, a good place to begin, I believe very strongly, is with Martin Pring's no short thing indicators, which are basically these 3 indicators here confirming each other.
Yeah, okay.
It's a great building.
I love the points that you brought up, because the psychology is so big part of the trading. What I'm trying to drill down to in terms of the indicators here is, let me phrase this a little differently. So if we are looking at this set of indicators, the fact that the price is moving above the moving average, and the fact that we have the momentum indicators above the 0 lines, that's what you're looking at in terms of bullishness or bullish indications. Is that correct?
That's correct. They're all confirming each other. Yes.
Okay. Lovely.
And the opposite would be like if rate of changes were below their 0 and price was below its 10-period moving average, then it would be the trend would be prices lower. Okay. So then you wouldn't want to be betting against the trend.
Okay, that makes a lot of sense.
Mm-hmm.
Did you want to share something about your trade trigger as well, or is that proprietary?
No, I don't want to say it's proprietary, but I think it also has to do with this trade became. I mean, look, let's go back old school Wall Street guys. They looked at GM shares, or Chevy or Ford, and Wall Street analysts would just go out on a weekend into a dealership and see, well, are there people buying cars? Are there people out there shopping? Well, man, economy looks like it's doing pretty good, So in this case with nat gas, I mean, I think weather had a lot to do with it. I mean, I was in the States for 3 weeks, and I had just gotten back a week ago to Cyprus, and so I was over there. I was on the ground. I was out and about. I was in shops. I was talking with people, just getting a feel for things. Inflation is, it's snuck up on them. It's very real. Things are very expensive over there. So energy, yeah, okay, it's going to go up. And then we got storms. I mean, there was weather was also affecting this. I mean, I'm also I trade sugar and coffee. They're also very sensitive to weather. I mean, and there's dynamics that happen during the drier months that are that happen pretty much every year. Then you got in wheat, when you got different you got the crop season, you have to pay attention to that as well, when there's a lot of demand coming on at the end of the season. So there's a lot of dynamics to it, and each market you trade, you have to understand that market, not only price action. You got to understand the underlying factors that drive a market, especially on commodities. So.
Okay, I totally agree with your points. It's something that every trader needs to focus on, and maybe I'm just saying this for the benefit of new traders, that if all this sounds like a little bit overwhelming, it just highlights the fact that you need to learn to develop yourself. You need to learn. Trading isn't about taking a method and just trying to make it work. Trading is about developing yourself, getting better with your psychology, with your process, with execution, with market analysis, with understanding about the markets, and that comes over time. But hopefully, if you join to my webinars, I will show you how very simply you can start developing yourself and find trades like the one John was referring here to. But also, I hope that from this webinar or this panel discussion, you'll get out some ideas, you get some takeaways that you can actually apply in practice, and I hope that this is something we can give you. Let's move on to Gonzalo now. There would be so much more to talk about. I'd love to have this panel together again, and I would love to dive deeply into a lot of the factors and things that you have mentioned, but we are a little constrained with the time. So let's move on to Gonzalo. So what is your primary approach? What would be your desert island indicator?
Well, I would agree a lot with what John just said, taking into account the macro context, because by taking it into account, you are already cutting in half your trading decision. If there is an inflationary environment in terms of commodities, you will only go long. You are cutting sell trades already of your plan. Yeah, so you have a clear direction. And that takes a lot of guessing and analysis. So you look for a long setup.
True.
And in this context, I would say, with commodities, with stock indices, where we see the market behaving just in a kind of green higher flash crash, green higher flash crash. Just plot an RSI. Accelerate the RSI a little bit to, I like the 9 period, just to shorten a little bit the time to make it a little bit more sensitive than the 14 period, the standard setting. Go on weekly charts, daily, and into intraday. Obviously, on the higher charts, the frequency of trading will be much lower. But look for a pattern that has the following characteristics. You have the RSI thresholds: 30 on the bottom for oversold, 70 for overbought. You want to see a market that plunges the RSI into oversold coming from the 50 level or above. This means a fast moving market down. It stays below the oversold threshold for not more than 10 periods, and then goes back again and crosses the oversold threshold up with a tick. Yeah,
sorry,
this kind of pattern.
Let me ask you, as I was adding this indicator and the chart, I kind of missed which market you were referring to. So I have.
You can do this on oil, for example, or on West Texas, for example, or if you want the S&P, just not to repeat the commodity.
Okay, SPX.
Yeah, with commodities we had surges basically everywhere, but yeah, as Gon mentioned, a few flash crashes. Maybe the most notable was lumber, which went crazy and then tumbled, so lots of volatility over there.
The thing is that markets are very much driven by liquidity issues these days, so you will have these episodes where they correct very fast. But usually the behavior that you are seeing in stocks and commodities is that support levels are very strongly bought. You see these large lower wicks in the candles, these spikes that are heavily bought. So you don't see really distribution here. You see opportunity for accumulation at any opportunity of a reversal. You see buyers piling in. You don't see really reversals that change the structure of the charts into something more bearish. So I would focus only on going long these markets, and if you want a signal trigger for a long signal, use the RSI. Accelerate the RSI to 9 period. Mark on your RSI is a close indicator, so it will operate between 0 and 100. you establish the oversold threshold at 30.
Let me cut in here. So I have now added the RSI 9 period into the daily S&P 500 chart.
Okay.
So looking at your approach, you would like to actually have this indicator moving below 30, was it?
Yeah, if you go on the 8-hour chart, for example, look at the 8 hours fairly good.
You don't have the 8 hours set up here. Can we use 4 hours instead?
Sorry?
Can we use 4 hour chart instead?
4 hour? Okay, yeah, sure.
Oh, okay. Right. So here we have a couple of occasions where the indicator moves below the 30.
Exactly. Observe how these reversals from below the oversold threshold correspond to bars or candles on the chart with having larger lower wicks or being large candles, large reversal candles, like involving candles or of that sort. So the lows are very fast bought, and the market keeps rising. So you see that is happening.
Just to highlight this for new traders, here's the first occasion, and this was 17th of August. This is the first time for quite some time that the indicator goes into oversold territory, and the next day we have an update. So what would be your entry method? Before I ask you, or before I let you answer the question, we have the second occasion here. The market goes again into the oversold territory, then goes a little deeper, and then turns. So clearly there are some challenges, at least in 4 hour time frame, using this indicator. How would you deal with these challenges?
Well, to start with, you will have trades that signals that will have no follow through. Yeah, that's for sure. You have to make sure two things: that the pattern on the oscillator really translates what the price is doing. We want to see a fast moving market towards a buying level. So the RSI has to come in a linear fashion from above the 50 level into the oversold, a clear pattern, and that way. The one we are seeing on the screen is perhaps not the best one, but if you go over the 8 hour, you will see on the 8 hour it will do that. If users have the chance to look for this pattern across several time frames, and then the RSI stays for a brief period on the oversold. You have the price then just stabilizing, hesitating a little bit, and then the RSI going up again, crossing above the threshold, and the market reversing. Yeah, and that would be the entry signal. At the first closed trade with the RSI above 30.
I actually added 8 hours here, so now we have an 8 hour chart.
8 hour, okay.
Yeah. So this is where I'm going to use a vertical line to point to.
We have the signal, for example, in July, on the 19th July. We have an interesting.
So here's the first time that the market goes into the overbought territory. It stays there a little while and then starts to move higher. So with your entry technique, would you be interested in buying here, or scaling down, or scaling in, or what's your
you can add to this method? Is the name of the game is accumulation. You just accumulate. So you can do it to build a position long term. You can just use with a more short-term time horizon, and because these reversals usually, if there is a follow through, put you in profit fast, so can move to break even and go for the next potential target resistance. So you can use it as more of kind of a swing trading strategy. But as I said, you can just pile into the position. Just be careful, because from time to time the market will erase all these levels in a correction, and then we'll start over again and again. So be careful with that. But
can I challenge you? Can I challenge you a little bit?
Sure.
I agree. First of all, I do agree with the principle that in an uptrend we need to buy the dips. But
Yeah,
now
it's been working for a long time.
oh yes, it's been working
with one big exception.
Yeah.
A year and a half ago, but yeah.
Yeah, that's true. So they'll always, just to remind, and this is actually related to what I was going to talk about here, the risk management. So it's okay to say that we need to pile in, but most of the new traders, or most of the traders, are using some sort of leverage. So going into a volatile market, buying to the downside is a little challenging. So how would you do that while keeping your risks managed? How much should a trader risk per trade or per day or per position that he wants to build?
Well, leverage is as important as the analysis. So if you are look at your capitalization level and calculate your effective leverage. Really, it's not the leverage that you're allowed to trade through your broker, but the effective leverage. Compare the size of the position the market you want to trade with your margin account and establish a relationship. Do not go over 5 or 10 to 1 in your leverage. Otherwise, you are just too leveraged, and with one loss, the next trade you are even more leveraged. Yeah, so look into that. So if you can trade the Dow, try to trade the S&P, and if you can't trade commodities or stocks, look for a proxy. Canadian against the yen as a proxy for oil, and that sort of things. Yeah, in the forex, so you can use a lower leverage. But I would say keep it simple in terms of the signal, but then try to contextualize the signal in terms of support resistance. Yeah, just start at the weekly level. There is something very easy here to do on a weekly chart on the S&P. If you go back to the 2018 high, if you switch fast here to the weekly chart, you can see that between that high in February 2018 and the high that we produced this last week, yeah, you can establish a line. In order to contextualize those dips along the way, you need some sort of indication if you are at an important support or not. So you can construct a grid and doing this on a.
So here's the 2018 January, and then going to the September high. It's here.
Okay, if you establish a trend line from that high in 2000 in January 2018, exactly. So, place where we are now.
Let me go there just a moment.
Yeah, is this a weekly chart?
This is the E-mini futures on weekly, yes.
Yeah. Are you on a log scale or arithmetic?
This is just normal scale. I can go to logarithmic.
No, because I'm looking at the log and the line doesn't fit to what you are seeing here. Yeah.
We can.
In any case, we can cut this off just not to confound our users. The point is, if you put those points together, the initial anchor level and the recent top we just got.
You want to do this?
Exactly, and the one that in back 2018.
Okay.
And you start moving that line with parallel copies of this line. You will see that a lot of other levels start to emerge, support and resistance, right? And you can do this exactly there. And if you take a low from the low in 2020, the same angle of ascent, yeah, you get a huge area there where we could eventually crash into. If you replicate another line and you anchor it on the. Yeah, exactly. Okay. On that low. On that exactly. A parallel line that is a parallel line to the ones you
Oh, I see. So I copy this and take it down here.
Exactly. So you get a upwards sloping channel there. So yeah, and you would do the same with descending lines. Okay, for example, one line at the starting point where you have the first line there, and the starting point there, and towards that low in 2020.
Like this.
Yeah. to the 2020 low.
It's starting to look like a pitchfork.
Yeah, similar.
Yeah.
And you take parallels of this as well and move these parallels along the way, so you get kind of a grid. Yeah.
Okay.
So, and this grid will allow you, in combination with the RSI signals, to contextualize them. Yeah. If you see that the RSI pattern is emerging on one of these lines or line intersections, yeah, you get a kind of confirmation or additional confirmation that you are at a good place. And you can do this going down into other timeframes, because if you go lower here into daily or intraday, these lines will appear almost parallel, because you have to find the same angle on lower timeframes if you want. Yeah. So you do the same exercise one and again. And
I sorry for interrupting here, because I'm a big fan also of GAN, and I mean, where is your 40? I mean, I guess I mean, are you measuring your angles?
Around 40-45% would be ideal. Yeah, exactly. Yeah, exactly. So that you have this angle that will vary a little bit between markets, but will preferably be of that with that angle. And then
it's a nice approach. I like the grid here. It's old school, drawing, and it doesn't go out of style.
No, never. And it cuts the time to analyze the chart, because you already have the lines, and as the market progresses, you just copy the lines and move the lines into the future. The market will behave accordingly to its angle. Mm-hmm. And in order to plot the lines, you use highs, lows, you break out gaps, any emotional point on the chart. Use this to anchor your lines. And the interesting thing is, when sometimes you have a descending line from a very important top, you have a descending line, and then suddenly you have a little bit of a breakout hurdling that line. And what the market is saying is it's well off that high, but it is crossing a line that emotionally comes from a very important high. So the message is the market is ready to start trending again, because it is hurdling a line that comes from a very emotional point on the chart, technically significant, an important high, an important breakdown, whatever. So the market trends.
Can I interrupt you here? We are almost out of time, but just to clarify on your method, how would you use the current chart in S&P 500 and this grid, presuming of course that I have not drawn it really badly wrong, but how would you use it now to look for a level to buy? Does this actually imply that we have quite a bit to go to the downside before we have support? Or
from this perspective, yeah, we can see, yeah, if in terms of the oscillator work here, we have been flirting with the overbought level for a long time, so we haven't seen really a correction here on this time frame. So here, the market would ideally go to one of the lines first in order to get oversold again and to be bought under this time horizon here. Yeah, but then you would repeat this on exactly. You start establishing intersections using these lines, dynamic lines with a horizontal line. Then you start also getting double and triple intersections. Do you see this triple intersection here, that with your horizontal line, the ascending line, the descending line, and just go over that and look at in terms of time when it is, and take note of that intersection in terms of time, and do this in other markets. And sometimes these intersections coming into the future will tend to cluster. Yeah, and so you have a date where you have to be aware something can happen around that date. Either you have an acceleration price, you have a reversal, a change of trend, or breakout, or whatever. Usually these intersections, they play out in the future in terms of a timing indication.
All right, so, lovely. I really have to cut you here because we have run out of time, actually, by almost doubling the time that we're allocated. But I knew this was going to happen. After talking with you guys yesterday, I knew that we can't cover everything in 40 minutes. But this has been really interesting. This has been I think this has been a discussion that asks for more. We should do this again in the future. So maybe just with one 20-second sentence or one 20-second allocation each of you, what would you say you have learned from this discussion, listening to the others? What has been beneficial? Yohai, do you want to go first?
Go for
ahead,
it,
John.
Yeah, I think it's what I've learned is that there are others out there like me, and it's nice to surround yourself with those who are as passionate and committed to the markets, and are continuously developing themselves, so what I've learned here is to keep on learning and to learn from others. There's no substitute for experience from other people, so everybody has their kind of unique inputs here, so the grid setup, I really like that. I'm very pattern orientated, so I do like the geometry of your approach, and the nature of it, and Johan, you have your own special unique edge as well, looking from the political side of things, which is it's something that's doesn't get enough attention to, but there are significant political drivers that are that force the markets, and it's good to take advantage of them, because a lot of those political things are just it's a noise, or it's something that just has to be corrected at some point. So and Jan was actually one of my mentors. I learned a great deal from Jan over the years as well. So
cool. Thank you, John.
Yeah,
so
I learned well from both of you that I need observe markets, patience, and you just cannot accelerate experience. So you need to look and observe and find your own way. And I certainly agree with what John said in general, that you need to feel comfortable with the trade. So if in your case you have 3 indicators, you're confident these are your tool set. If one of them falls apart, just becomes neutral or stops making the bullish signal in that case, then you're out. And so patience and experience, and taking a deep breath, even if markets are fast.
Yeah. Thank you.
Indeed, what I learned is that simplicity at the end of the day is the place you want to go back to as you progress, because you will add a lot of things into your toolbox, and you will tend to become more analytical, more complex in your approach. But going back to the basics, it's always good. Taking a perspective into higher time horizons is good, and having in mind what is the actual macro outlook right now. It does not fit entirely with what we learned in textbooks earlier, 20 years ago. So it's a bit crazy. Fundamentals are put upside down, and it's a lot about capital flows and liquidity issues. And this is how the markets are are behaving, and but we can turn this into also a simple approach just by having this in mind. So that is the two main points I would have learned from my colleagues.
Thank you. And what I have learned from you guys is that it's actually reinforces something that we probably all know, but there's zillions of ways to make money from the markets. Obviously, there's the other side of the coin as well. but to see you guys approaching markets differently, but still there are certain common themes that are useful. So I'm hoping that you viewers will be getting something out of this. After, maybe you have to watch this a couple of times, make notes, understand more, and it's very good stuff. Thank you, guys.
Yeah, you're most welcome.
Thank you very much.
Thank you for the opportunity.
Yes. Thank you very much.